What's up, YouTube? It's the Money Man here, and today we're talking about another school of investing. Today's school is technical analysis. One of the more famous technical analysts was Richard Dennis. He's famous for bringing $5,000 of his own money and developing it into $100 million over a pretty long period of investing on futures and commodities. He's also famous for starting the turtle trading experiment, which was an experiment where him and another famous trader brought in a group of 14 or 15 novices who had no experience in trading or technical analysis, but some decent skill in mathematics. I taught them a system involving technical analysis and trend following and breakout patterns, and the system actually worked. They were able to make a profit and turn money. So the basics for technical analysis. Technical analysts believe that history repeats itself in price movements. That is, the price of a stock will tend to historically repeat the price movements of other stocks have traditionally. The other part is that prices move in trends. That is, if a stock starts going up, it will continue to go up until it hits a certain point. The same with downward movement, not just limited to upside. They correlate this with the volume of the trades that are moving the stock. This is to show that it isn't just one or a couple of very large investors moving the stock, that the stock is actually moving because the market is dictating that it's going to be moving. They use historic price chart patterns, some of which you may have heard before, such as Head and Shoulders. What these really are is historic patterns inside price movement that seek to indicate future movement. For example, if you see a Head and Shoulders pattern that goes upwards, it means that the price is about to break out downwards, and vice versa if you flip the Head and Shoulders upside down. Technical analysis also use such indicators as moving averages. They take the moving average of a stock of either 100 or 200 days or however long you really want, and they look to see if the price movement is above or below it, and if it's cyclically moving above and below it, or if it's just about ready to break out because it hasn't beaten the average in a while, and it just did. Technical analysts also look strongly at support and resistance lines. So resistance line is what a stock is looking to break out through, and it hasn't managed to yet. That means it keeps repeatedly climbing up towards a number like, say, 50, but it doesn't actually surpass 50. It drops down again and then comes back up to 50 and then drops down again. That would be what we would call a resistance line. A support line is a line on the bottom end of a stock, and that is the stock keeps going up, and when it drops down, it doesn't seem to drop down below 50. In other words, it may go up to 60 or 70 and then drops back down to 50, but never falls below 50, or at least hasn't over a certain period of time. These resistance and support lines are sometimes mathematically based, but for a lot of technical analysts, they're also psychologically based. And that's why they believe that stocks will fall in line with these support and resistance lines. Technical analysis is very unlike fundamental analysis, where fundamental analysis looks at the underlying business, its models, its financials. Technical analysis does not care about that. They care about price movement and volume, and that is their focal point. Alright guys, that's it for today. I hope that this kind of introduced you to the world of technical analysis. You can check out Investopedia.com for more great information about this school of thought and to figure out actually how to draw the lines yourself. Like if you liked this video for its content, subscribe if you want more about schools of investing or other finance related matters, and as always, watch what you're doing with your money.